Good morning from our global headquarters in New York. I'm Manus Crenny with Denny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Israel troops take control of the Rafah border crossing as ceasefire talks drag. UBS soars. The Swiss bank returns to profit as wealth and investment banking beat. And up next in earnings, Disney may post another subscription gain before the bell today. Good morning, Manus.
Let's hope that they keep the dream alive, Danny, at Disney, because we've got, again, momentum is in our favor. Two-year notes are down in terms of yield, 480, so we've moved over 20 odd basis points in the space of a couple of days. Positioning in this market, according to Pictet, U.S. exceptionalism is overrated. Well, is it? Have a look at some of the stocks that we're tracking for you. Lucid Motors down by over 8%. Again, a bit of a challenge there in terms of the loss per share. Keep an eye on UBS, soaring higher, as you say, in the headlines. This is about a bank returning to profit, running down its non-core assets fast and furiously, and building up capital to the level that systemically may be required. Two-year yields are down by 2 basis points. The cuts are coming. Ken Griffin said that they will be here by Christmas. I believe in Ken. There was a hunger for the 6-month T-bill auction yesterday afternoon. Today, we're going to see a little bit more of a test. $58 billion worth of 3-year paper. Morgan Stanley talk about a rapid deceleration in the PCE. Buy bonds. The narrative was very clear. Dollar yen, we've just had a few lines from Ueda. This is the dollar up. This is the yen down again. The consideration is what happens next. Ueda had a meeting with Kishida where he said they are monitoring the weak yen and its effect on prices. But for now, no repropulsion of yen strength. Danny, good morning.
Good morning, Manus. All eyes to UBS this morning with that earnings report. And this is how you set the bar low, Manus. It was only in February we had heard from Armati that said 2024 is a difficult year. It is a pivotal year. Not that it means it's not difficult, but setting that bar low and then returning to profit, good results for investment bank, huge results for wealth management. That's how you juice up the share price.
Well, they sold assets to Apollo. They took in $272 billion for that, $272 million for that. And, of course, they're already accumulating capital. And this is the critical issue in terms of what the regulator are going to ask UBS to put aside. But Bloomberg's Francine Lacroix, she sat down with the CEO, Sergio Motti. Let's take a listen.
Actually, it's a good momentum. You may remember in the fourth quarter, we also had a very strong performance in banking. As we integrate the new colleagues from Credit Suisse on our platform, we start to see the pipeline developing. We are able to execute. And so it's very much aligned with our expectations of improving the mix between our markets business and our banking business in the investment bank.
So in the investment bank, where do you see the biggest strength? I know we also heard about possible job losses in Asia. Is Asia at the moment weaker than, for example, parts in the US and investment bank?
No, I think that we reinforced our franchises globally. I think that, of course, we are still going through across the entire bank. We are still a lot of work to be done to restructure the businesses and to bring them back into even stronger profitability. So I think that is a good momentum. We achieved almost a 10% return on CET1, which is still a third or 50% away from our final target. So still work to be done. We always say that 2024 is an important year. And as we now approach the end of May, we're going to execute on our legal entity mergers, which allow us to unlock in the future further cost savings.
An important year, 2024, because it's also a more difficult year to 2023?
No, because it's a more, first of all, we have two huge milestones, the merger of our legal entities, and the second one, we start to do the migration of clients from the Credit Suisse platforms into the UBS platforms. So this is very technical, still requires a lot of support and people to do that. And but as we start to do that, we can unlock some cost savings, but also unlock capital savings, funding savings, and therefore achieving our final targets to achieve 13 billion of savings by the end of 2026. For this year, we do expect half of that being achieved, so 6.5 billion.
Sergio Armati there, speaking with Francine Lacroix. Joining us now is Andreas Venditti, Senior Analyst for Banks and Asset Managers at Vontobel. Andreas has a buy rating on UBS. Thanks for joining us this morning. So here we have a profit from UBS 3 times what analysts had expected. Andreas, is this UBS returning to its greater glory?
Yeah, it would be nice. Well, actually, the biggest part of the beat versus our and consensus estimates came from the non-core and legacy portfolio, where they showed a much faster improvement than expected. And this is something that firstly is lumpy. And secondly, it's not really a straight line development. So there, I think the estimates were most far off. Of course, it's a positive, but I don't think each and every quarter now will see such a very strong performance from the non-core and legacy rundown.
Well, certainly, if anybody has form in understanding how to run down non-core assets, that team that's in charge probably do. I'm looking at the cost reduction narrative that Amoti just discussed with Francine. The cost reduction target is $6.5 billion, or over 50% from the original target that they had for 2026. So this is classic Amoti, which is front load, push the cost cuts in the very, very near term. Is that also a boost this morning?
Definitely. And if you look at Credit Suisse, they also published this morning that the Credit Suisse part of the business still reports 900 million loss, basically because it's a structurally unprofitable business, mainly due to the cost side. And that's why the cost rundown is so important. And yes, they're on track there. And that's obviously also part of what investors like today.
Well, I mean, they cut underlying expenses by 5%, but I guess can it continue if we're looking at something like another $1 billion in those integration costs, to Manas's point? I mean, the trend is good, Andreas, but how long can that last?
Well, you have to see that after legal mergers, which they announced now at the end of this month, they will only actually be able to start eliminating all the duplications which come with two very large legal entities like UBS AG and Credit Suisse AG. Because basically you have many, many functions within these two legal entities, which now they have double, which they have to keep running double until you have this legal merger, which will happen very soon. After that, you can start cutting actually these duplications. And that's going to be, another big wave, obviously, of cost cuts. Unfortunately, of course, also some redundancies for the people involved. Not really nice, but that's how it is in such a merger.
Andreas, Amoti also said on the call that they're already accumulating about $20 billion in capital. Now, this speaks to the risk on the too big to fail and the requirements of capital. So the institution is already prepared for. Is that a worst-case scenario, or is there lobbying between now and execution that could materially change that $20 billion in capital, additional capital requirements?
Yeah. Well, you have to see that this is, in part, a political process here in Switzerland. And of course, UBS is very clearly doing some lobbying to explain how this looks like. You have to understand that, politicians are probably not very familiar with these kind of topics. They are not bank analysts, of course. Mm-hmm. So they need to get familiar. There is some view in the political system here that basically rightly is, you have to protect the taxpayer. That's for sure. On the other hand, there is some view that says the more capital, the better, because the institution will be the safer. And I think here some people do not really see that capital is only one part of the whole picture. There's many other parts. And I think only focusing too much on the capital side is not really the right way. Okay. Also because, it's not only an absolute gain of how much capital in absolute terms you need to hold, but also, in my view, a relative game. How do you stand compared to your main global peers? And here, I think UBS already stands in a very good position. Some further increase can be okay. I mean, that's not an issue. Mm-hmm. However, you could also go too far here. And
indeed, I think that therein lies the very essence of the debate at the heart of Bahnhofstrasse on the street relative to inside the headquarters. Andreas, thank you so much for joining us this morning. Vontobel's Andreas Venditti there with us. And Danny, this plays too. If you go to your T-Live blog, you'll be able to see exactly the narrative from UBS. Amoti, to use Amoti's language, UBS will advocate a proportionate outcome on the front. And that's how it's being framed.
Right.
So this is about trying to negotiate because the buybacks are still in play and the dividend still reigns supreme, and the price to book value of this bank is way ahead.
Well, the issue that Andreas talked about is this is not something politicians typically deal with, that perhaps their knowledge is different than that of Ermati, which I think is also why he's framing this isn't important for us. This is a matter for the country. We are the Swiss bank now. Again, he says this is an important discussion for the country. So he's trying to frame it in perhaps a way that politicians would view favorably.
Listen, it's a tough line to run for Colin Kelleher and Ermati. You've got shareholders on one side who want dividends and buybacks, and you have politicians who simply, they're there to protect the country, and they have their job to do in terms of the argument. It's a hot potato.
Which, by the way, perhaps doesn't look great with wonderful results from UBS and job cuts to come.
It doesn't. Anyway, they're reducing the risk-weighted assets at a pace, and they're ahead on cost-cutting targets. Some of the stories trending on the Bloomberg terminal for you this morning. This is what we've got for you. JP Morgan is starting a new round of layoffs in Asia. The bank said it will cut at least 7 more investment banking jobs in the region this week. And separately, Citi's custody unit shifted to work hours of some staff in Asia to Tuesday through Saturday to align with the US.
Last night at the Milken Institute Global Conference, Elon Musk talked regulation, space exploration, and you guessed it, AI.
I mean, AI might be the most important question of all. The percentage of intelligence that is biological, grows smaller with each passing month. Eventually, the percentage of intelligence that is biological will be less than 1%.
And scores of pro-Palestinian protesters were blocked by the police from getting close to the Met Gala. The gala is the most exclusive annual event in New York City. The glitterati, they turned out in force. However, the demonstrators were heading towards the venue, the Metropolitan Museum of Art, when they were intercepted by the NYPD. A group had tried skirting the police, going via Central Park, but were met with barricades and threats of arrest.
President Biden plans to denounce anti-Semitism at college campus protests in a speech today. He's going to be delivering the keynote address at the U.S. Holocaust Museum's annual Day of Remembrance. That's at 11:30 a.m. in Washington. The speech highlights Biden's political dilemma 7 months into Israel's war in Gaza.
Coming up on the show, we'll discuss Israeli troops taking control of the Rafah border crossing as it rejects the proposal of a ceasefire.
And BP keeps its share buyback, but overshadowed by a net income miss. All of that to come on your brief.
This is a Bloomberg Brief. I'm Ennis Cranny alongside Danny Berger in New York. Well, Israeli troops took control of the Rafah border crossing, that area in Gaza, making the first time the army has moved into the area since the war with Hamas began in October. Joining us now is Bloomberg's opinion columnist, Mark Champion. So it looks as if these let's say, cessation of hostility discussions have stalled, and this is an escalation. Is that the right way to frame this move by the Israeli into the Rafah border?
Yeah, absolutely. I mean, what we saw was Hamas saying that there's this agreement, mediated agreement that we've now signed off on. But it turns out, according to at least the sort of purported text that's been published by Al Jazeera, that agreement is very clearly an effort to kind of paper over difference with Israel. Israel was kind of taken by surprise. And the bottom line is that, Hamas remains committed to getting a permanent ceasefire, and Israel remains committed to, retaining the right to eradicate Hamas, regardless of any temporary truce. So they remain, far apart, as the Israelis have said, and they're already starting their move into Rafah, which is, extremely disturbing.
You know, and there have been plenty of those who have questioned really the impetus behind Hamas agreeing to a ceasefire, whether it's in good faith. Academy Securities writing that some are speculating the announcement is just an effort to avert the invasion of Rafah and, quote, put the ball back in Israel's court. So if the ceasefire works, talks continue to draw, Mark. And next we're looking, as we already are right now, of Israel in Rafah, continued strikes from Hamas to Israel at various border crossings. What does the next weeks look like, Mark?
Well, it's going to be ugly, I think. I mean, you know, the first thing that's happened, the first move they made was to close the border crossing at Rafah, which is, they're critical in terms of getting aid and fuel into Gaza. So that border crossing is now closed. And it's likely to remain closed for the duration of hostilities. So, it's the sort of improvement that we've seen recently in terms of the amount of aid getting in with the opening last week of a couple of crossings in the north. That is not going to remain improvement. It's just going to be, an effort to keep the level of aid that's getting in, which is, just sustenance levels, really, to stay. And then you're going to have, a continuing problem of more than 1 million people who've moved to Rafah to seek safety. Only the Israelis have been trying to evacuate some, 100,000 they asked to leave from eastern Rafah. We'll see how that plays out. But it's quite likely that we will see a repeat of what's happened before, where these evacuations come rather too late and a lot of civilians get caught up in the crossfire.
Hey, Mark, we appreciate your time this morning. That is Bloomberg opinion columnist Mark Champion. Okay, now let's turn to the oil market and the big oil majors. BP is maintaining the pace of its share buyback. Aramco is also keeping its $31 billion dividend, a payout to the Saudi government. Joining us now is Bloomberg's Will Mathis. Obviously, everyone wants to know about the dividend. So, Will, BP's keeping it going.
Yeah, the big thing right now for BP is the buyout, which they maintain. They had a target for the first half, which they reiterated. They're going to meet $3.5 billion of buybacks. And that's really key for the company right now, that they can show their shareholders that there's money to come from holding these shares, and try to lift that up and get more competitive with, Chevron and Exxon in the U.S. that trade at a much higher multiple.
Well, I think when you have a look at Aramco's dividend policy, I mean, this is where the world salivates at the idea of another slither of equity being released from Aramco. And all eyes are on that policy, that dividend policy. How is that evolving? How would you contextualize that relative to the global majors?
Yeah, well, I think that while BP and Shell have their shareholders that they need to keep happy with buybacks, Aramco's main shareholder also needs to get paid out. Saudi Arabia has big ambitions with building a new city in the desert, which they need a lot of money to be able to do, even though they've recently scaled back those very expensive plans. And Aramco, maintaining that dividend to the Saudis is critically important for those national goals.
Yep, well, $30 billion, $31 billion is a chunky payout, and the break even that they need for some of these projects is rising incrementally every time we touch on the story. Will, thank you very much. Will Mathis there, covering the oil majors and the dividend story right here on Bloomberg. Good morning from New York. What a beautiful day.
It's your Bloomberg Brief. Danny Berger and Manus Cranny in New York are like, all right, let's get to some of the front page news, some of the things that are making headlines around the world, Manus. So first up, I've got the New York Times. So they basically are saying, look, because the labor market is improving, the outlook for Social Security and Medicare got a little bit better, but it is still grim. This is from their annual reports. It's released on Monday, and basically saying that Medicare will be unable to pay all of its hospital bills starting in 2026.
Okay, I mean, that is a huge fiscal issue. One major issue making TV screens around the world are the scenes coming from the various universities around the United States. Columbia University is just the most recent. They've cancelled their main graduation event. This is after weeks of tumult on the campus, Danny. Protests against the war, focusing on smaller scale celebrations. This is what they're going to pivot to. I mean, just think about it. USC's also cancelled their main ceremony. So this really is beginning to have a material impact on the campuses.
Right. We also learned earlier this morning Biden's giving a speech at the Holocaust Memorial talking about what he calls the anti-Semitism on college campuses. Finally, Manus, we have Xi, who is still in France. This is the last day of his 2-day trip. Apparently, they're heading to the Pyrenees today, where Macron holidayed as a child, so that's nice. Here's the line for me. This is what she said. We oppose those who use the crisis and throw the responsibility on a third party and call for a new Cold War. Talking about Beijing's support for Moscow, that message is squarely positioned to Washington, saying don't use this as an excuse for new Cold War.
He also talked about actively seeking peace and calling for a ceasefire during the Paris Olympic Games. But von der Leyen's exchange, where she said they had an honest and robust exchange, this was behind closed doors, talking about China's overcapacity on electric vehicles. That's well known and well covered. But the unsustainable imbalances that Europe would not waver from taking tough decisions.
By the way, Macron, I think, got his win on brandy. He said that she doesn't want preemptive taxes on cognac. So, you know, success.
Louis Vuitton will be happy.
From our global headquarters in New York, I'm Danny Berger alongside Manus Cranny. Let's set your agenda.
Israel's troops take control of the Rafah border crossing as the ceasefire talks drag. UBS shares soar. The Swiss bank returns to profit as wealth and investment banking beat. And up next, the earnings from Disney may post another subscription gain. That is before the bell today.
The labor market is cooling and surely inflation will follow. That seems to be the narrative that this market, Manus, is grabbing onto. But can you trust it? Equity market, 3 days of gains, best run since November, up again this morning. Just barely, though, less than 0.1%. You've also seen the gains come for the Treasury market. We are now 20 basis points lower on your 10-year yield over the past 4 days. That is the biggest drop down in yields since we've seen in February. The front end, though, that seems to have run out of a little bit of steam. The gains there started to dissipate yesterday. Finally, dollar versus yen. The pressure is still upwards on this currency pair. Dollar stronger by about 1/3%. First, we heard from Conda this morning, and then we heard from Ueda saying that he had met with Kishida and said that we are monitoring the weakness in the currency to see what impact it might have. Manus, that's a comment we have heard many times, but Conda saying we won't intervene if markets are behaving orderly. If they're behaving orderly, I mean, you could argue this is based on fundamentals. Seems like an invitation for the yen traders to come in and continue to beat it up.
Well, we know a quasi-parameter around what is orderly, which is a move of more than 4% over a very, very short period of time, which was part of the reason why the market believed that they had intervened. You talked about the rates move, and this is fundamentally the challenge for the Japanese. Even though short-dated rates, I'm looking at the short end of the curve, you're looking at the 10s, we've got a pretty big auction slate this week. If you look at that movement, at one stage it was like 28, 29 basis points for 2-year notes. We're back at a drop of 18 basis points over the past 7 trading days. That rate gap is ultimately the headwind for Japan.
No, but it's such a good point because there's so much volatility in that rate gap. When you get these kinds of moves in the bond market, a bond market that's acting more like corporate credit or acting more maybe even like the stock market, you're going to get that volatility in the yen, and it's fundamentally based. So to say, okay, we're not okay with orderly moves, what happens when non-orderly moves are based off of fundamentals?
Well, it's going to take a little bit more than the $60 billion that they threw at the wall last week to change the mind and to take the carry trades off the table, which hasn't happened. And that's what Kit Duke said 24 hours ago. The carry trades are still live. They're still out there. They've not been taken out. And until that happens, you don't have a catharsis in this market.
The shorts are still alive and well. One thing that the Japanese, that the MOF has going for it, is the optimism that the Fed will cut. That is growing. And we heard from New York Fed President John Williams and Citadel CEO Ken Griffin. One of them has a say on policy, the other one does not. But both spoke about the trajectory of what this year looks like.
As the data, come in, hopefully we'll be moving in the direction we want to see, both on inflation and in terms of restoring balance to the economy, and then we'll make our decisions based on that.
If they haven't cut in September, they're likely to cut in December. Again, there's still a question of, will inflation actually decelerate enough by then?
The land that dreams are built on, rate cuts. It's now Aaron Kennon, co-founder and CEO at Clear Harbor Asset Management. There's Ken Griffin. He's keeping the dream alive for December. The rates market has really had a new propulsion, hasn't it, Aaron, over the past 7 days, right the way across the curve. But it is the short end, 2 years, sub 5%, which has injected a new sense of pro-risk narrative, and rate cuts will come. Good morning.
Good morning, Manus. Yeah, absolutely. Certainly, that was the lead. I apologize. So certainly, when you look at what just transpired over the last, call it, week, the labor data coming out of the U.S. on Friday came in weaker than expected. We had the employment cost index, which was significantly softer than anticipated. You look at other important employment surveys, which, of course, the Fed is looking at to try to gauge whether or not they're going to hold for longer, possibly raise rates, which I believe is probably far less likely than them cutting rates. The quits rate is trending downward. The conference board data is suggesting a weakness on the margin on the employment front. So this all feeds into the narrative that maybe the Fed is going to be proven right in 2024, and that we could actually see up to 3 cuts this year. I think, going into last week, we were talking about 1, and now we're talking about 2, where it's a coin toss for a cut in July, and it's right now currently priced in at 100% odds of the first cut coming in September.
Well, Aaron, you write that the risk reward for bonds here looks more compelling today than perhaps any time since the financial crisis. But where on the curve, Aaron? I can understand the front end, given what you're just saying, given that there could be more than 2 cuts this year, that there could be 3. But what about the long end? In a world where we've started to debate, is long-term inflation really coming back down to 2%?
Yeah, well, I think if you just look at the real rate, Danny, you look at that 2.35% 10-year break even on the Bloomberg terminal this morning, and you look at where 10 years are, and you have well over 200 basis points of cushion there. Throughout the post-financial crisis period, we didn't have that sort of cushion. And so, what I was referring to was, if you take a look at, where we were pre-financial crisis, a couple of 200 basis points over the 10-year wasn't abnormal. And we're back to that point that we haven't seen in over 17 years. And I think it's quite compelling on the margin. I think on the curve, you need to be thinking about incrementally moving your duration targets a little further out the curve, and that just provides you with incremental protection in the event that the economy does slow down more meaningfully, and maybe the equity market experiences some level of indigestion. The 10-year Treasury, just when you look at the sort of the value of every 1 basis point move, is going to provide you with significantly greater protection than the 2-year Treasury, and so we just need to be mindful of that. So if that means moving from 2 to 3 years or 3 to 5, it just depends on what your mission and mandate is as an asset manager. But we would recommend making a gradual shift out the duration curve.
You're happy with the amount of term premium? I know it's dissipated relative to, we talked about this a couple of times where it was before Christmas, but you're happy there's enough premium in there, there's enough term premium in there for you?
Absolutely. We haven't seen these sorts of break even relative to the nominal rate of interest for well over 15, 17 years, Manus. And so we think that there's an opportunity there to sort of think again about that balanced portfolio where the foundation remains equities for most high net worth, ultra high net worth clients. But the fixed income piece is now, you're able to move away from money markets at well over 5% and think about the future of where rates are a year, 2 years from now.
Yeah, Aaron, but how many people this year have said it's no longer the time for cash? We got to get out of that, but it's giving you 5%. Warren Buffett even says he's going to have easily $200 billion by the end of this quarter. How difficult is it to convince people to get out of this thing? Again, when you're getting 5% by just sitting in a risk-free asset.
Well, Danny, I think that commentary that you just articulated so well is really a reflection on where valuations are in the equity market right now, less than with the opportunity set in the fixed income market, in my opinion. Warren Buffett has never been a fixed income manager. And so when you think about like the S&P 500 trading at 20 times forward PE multiples when it has a 25-year average of closer to 16 times, we're at the top decile of valuation. Now, we also know valuations can run high for a long period of time, so it's not a great timing mechanism, and we're very mindful of that. But then if you look beneath the equity market, Danny, if you remove the sort of magnificent seven, the equity market's trading at about a 16 times multiple. And that looks reasonably attractive, and there are opportunities when you look beneath the hood of the mega caps, which now represent a third of the S&P 500.
I'm just wondering then where you stand. Danny and I were sort of chuckling to ourselves. We've got Luca Paolini. He's on the investment committee over at Pictet. They run a few dollars as well. U.S. exceptionalism is overrated. Now, we're sitting here in the United States of America. It's easy for a man sitting in Switzerland.
It's sacrilege.
It's sacrilege to talk about U.S. Well, they're not the only institution. You've got Pictet and you've got Amundi. To be fair, both are in Europe, so it's a different perspective. Is U.S. exceptionalism challenged at any level? Do we need to begin to challenge our own thinking here?
Well, it's difficult for a man sitting in the Constitution state here of Connecticut, too, maybe to be unbiased. But I would just say that we have for decades, for 100 years, particularly at this current moment, when you think about our technological ingenuity, when you think about the opportunity to sort of leverage artificial intelligence, when you think about companies that are still critical to healthcare, both home and abroad, whether it's diagnostics. And, there's so much happening in a very positive way here in the United States. And when you think about the dollar and the depth of our fixed income markets, the global reserve currency is, in fact, still the dollar, although there is an argument that I can easily make that it is on the margin waning. And that is of concern and should be of concern not only to Americans, but of people in the West generally.
Well, just for a bit of context for that from Luca, this is about too much optimism about U.S. growth and too much pessimism about the rest of the world. And I think therein lies the clarity. So forgive me for not giving you that context around that.
Yeah, great. I mean, Manus, I think there's something to that. When you look at the growth picture in the U.S., I would argue that we're decelerating on the margin. We just saw services PMI data hit a 4-year low last week. I mean, there's evidence that the consumer savings rate is, essentially run completely out of gas. You look at the credit card utilizations are up. You look at auto loan delinquencies in the United States are up.
Yep.
But, monetary policy does work with a lag. You have the average mortgage rate of 3.6% in the United States, and 95% of mortgages are 30-year fixed rate mortgages. So it takes time for this high rate environment to really impact the consumer.
Yeah, but to be fair, Aaron, it is these small pieces of anecdotal evidence, and then you also get evidence the other side, which I think is what makes this market so difficult to trade in right now. Really appreciate your thoughts. Aaron Kennon of Clear Harbor Asset Management. Thanks so much for joining us this morning. Okay, coming up, back to the earnings. Disney is going to take the spotlight. As Manus would say, is it a whole new world?
Whole new world.
He won't sing for you, though.
Nope.
We'll try to convince him. Okay, That's up next. It's Bloomberg Brief, Danny Berger and Manus Cranny in New York. So Disney Manus is expected to register another increase in subscribers to its streaming service when it reports earnings before the bell today. It's the first report since Disney successfully fended off a high-profile proxy fight with activist investor Nelson Peltz. Let's get the details and bring in Bloomberg's Alex Webb. So subscribers in focus, Alex. We've seen Netflix, for example, surprise massively to the upside. So how high is the bar for Disney today?
Well, actually looks quite low. The company had said in February that they expected to add between 5.5 and 6 million subscribers. The market's actually looking for 4.7 million subscribers. So it seems as though if they just beat the market's expectations and don't meet their own targets, maybe they'll be rewarded. But the thing is, that's still half of what Netflix is doing. Netflix added 9 million subscribers in the quarter. So clearly, expectations for Disney Plus, which at one stage had really been growing a lot more quickly than Netflix, it has slowed. The change in the content investment has also meant that it may be harder to add new ones, but the bar does remain quite low.
So if we look at this report, it's going to be the first for Bob Iger since he defended against the activist investor Nelson Peltz. There's a weight of expectation in terms of assessing his turnaround plan. There he is in his resplendent glory. Has he delivered? Is he delivering enough to thwart activism and another assault?
Yeah, I mean, we're looking at Bob Iger 2.0, where he's talking about perhaps breaking up the company in a way that wouldn't have been conceivable 5-6 years ago. The massive cutback on content spending, I think in the order of $3 billion, that looks like it's going to be delivering a little bit more profitability. I think the market's looking for just over 1% growth on an operating profit level. So, it's not gangbuster numbers just yet. I think the really key thing we're going to be looking at now is Pixar, right? That's the big release coming up in June. They are slightly retrenching when they think about whether they're going to do as many sequels as they previously did. They slightly exhausted Marvel and Star Wars. Pixar is really the place where they come up with new ideas. If that's able to have an impact, that augurs well for what happens subsequently. I will absolutely watch Inside Out, too. There's no doubt about it. I will be the first one in the theater. Love that movie.
With popcorn?
With popcorn. Why not? The whole shebang. Yeah, I support our local theater. Alex, if we can shift a little bit. Okay, so Apple, the Wall Street Journal has this story that they are developing their own chip design. The best part of this, perhaps, is that they're calling it Project AC/DC internally, Apple chips in data centers, because Apple is just so cool. Investors have been lamenting, Alex, that Apple is behind on AI. Does this set them ahead?
Well, I mean, all of their competitors, all of the big tech companies are at least developing their own AI chips. I think often with these things, I would suspect, you might disagree with me on this, but this is actually about negotiating power with NVIDIA, right? That NVIDIA, one of the reasons that its stock has been in such a tear recently is not just that they are selling more chips, but the chips they are selling, they've been able to massively whomp the price up on. And so that is driving a lot of the profitability there. The reason then that you would think about developing your own is to give you a little bit more negotiating power with NVIDIA. And so I would suspect, of course, there are things this helps them do in terms of their own AI capabilities, but Apple is very canny when it comes to negotiations, and I'm sure this is a part of it.
Now, it was 2010. Steve Jobs was in charge, and he said PCs are going to be like trucks. And, of course, this was about the invention of the iPad. I've had a few, and I've got to say I'm at the juncture of where I actually quite fancy an iPad. I haven't had one for a long time. I want the keyboard. I want the whole thing.
The little pen thing.
So the marketing's working.
Yeah, look, I'm sorry to evoke a cliche here, but you could say iPads, I've had a few, but then again, too few to mention, because the thing is with iPads is you don't refresh them as often as you do an iPhone, right? And so that is why you don't see delivering anywhere near those sort of numbers. iPhone sales actually peaked at around $31 billion a decade ago. They've never hit that number since. So it's trying to find ways of getting people to refresh their iPads more regularly. We're going to see a few updates to the iPad Pro, to the iPad Air. That's what we're expecting today, according to our colleagues Mark Gurman's reporting. There'll be OLED screens in models that didn't have it before. Of course, an updated chip. It's hard to find those reasons to upgrade, though.
I don't think I need all those extras, Alex. I just need, the keyboard. And sort of just something that,
So the marketing hasn't worked well enough.
Well, when it comes to matters of style and substance, we know where I fall. It's style over substance every time. Alex, let's see how the great reveal goes. Great for joining us this morning. That is Alex Webb on the Apple story. Well, Boeing is facing a new investigation from the U.S. Federal Aviation Administration. The latest probe involves incomplete inspections of its flagship 787 long-haul jetliner. Sid Phillip is with us now. So this is another blow, not just to reputation, but about trust in the 787 program, isn't it?
Yeah, this is another blow for Boeing in terms of they're already under scrutiny from the regulators about the 737 MAX, and now the 787 is also in the crosshairs. And that sort of follows a whistleblower saying that essentially the plane maker didn't do sufficient testing and possibly falsified data on tests about the wing being joined to the fuselage. And so it's fairly significant and serious for Boeing. And they've said so far that it doesn't affect the in-service fleet, but the regulators have asked Boeing to come up with a testing and a sort of check mandate for that. And that's really going to be key in how the sort of in-service fleet performs, as well as new delivery. So we're still waiting for details from Boeing on what that means for deliveries of aircraft going forward as well on the 787 program.
Sid, I realize that Boeing's desires to go to space is not as core of a business as it is for their airlines, but we had the Starliner that was set to launch yesterday with the theory basically being this was necessary for Boeing to prove that they could take humans to space. And of course, the joke would be, do you trust Boeing taking you to space? Well, we learned the launch didn't happen because of a faulty air valve. I mean, what does this do to the image of Boeing? Whether or not this is really crucial to them, Sid, this is a problem.
It is, and so the ULA launch, which is Boeing's venture with Lockheed Martin, was meant to take off yesterday, and hours before the launch, they had scrubbed the launch. And this is a program that's, again, billions over budget and has been sort of key to Boeing's ambitions and hasn't quite delivered on what they want to achieve. And so it's just another program that Boeing is struggling to deliver and get it off the ground, literally.
Hey, Sid, appreciate it. Appreciate that pun, too. I'm sure we'll have you back again another time shortly for another Boeing story. Bloomberg's Sid Phillips there. Okay, coming up, Manis and I are going to set you up for your trading day with some of the events and your stocks to watch here on Bloomberg. Welcome back to Bloomberg Brief. Danny Berger and Manish Kranny in New York. Let's get you set up for your trading day. Disney will be reporting its second quarter earnings before the bell. And then Minneapolis Fed President Neel Kashkari is going to be participating in a fireside chat at the Milken Institute. That's at 11:30 a.m., where we already heard from other Fed speakers. Lyft and Reddit, they'll also report their earnings today, Manish, after the bell.
With some pretty big moves for you as we kick in here. Palantir falls. The market appeared unimpressed by the company's outlook for its annual sales, and the stock, it did triple in the past year. Lucid, look at this, down 8.52%, a wider than expected loss to the start of the year, and the company contends that its production challenges and uneven demand for, you got it, high-end electric vehicles. I mean, that is a bruising on that. Disney up over 1%. What are the subscriber numbers going to look like? Will they register another increase in that number on the streaming service? A whole new world, my favorite tune.
You had to go there, Manis.
I had to go there, but I'm not singing it. Go on.
You didn't sing it. It's such a disappointment. We all want a little bit of karaoke. No. Okay, I'll move on the subject for you then. A quick check on your bond market. U.S. 10-year yields come in by about 2 bips this morning, trading at 4.46. Manis, over the past 4 days, 10-year yields have come in by nearly 20 basis points, the most since February. It is a narrative that the labor market is looking softer. Surely inflation will follow.
I love what Morgan Stanley wrote yesterday. It was just a straightforward, good old-fashioned, no mincing your words. There will be a rapid deceleration in PCE. Buy bonds. It was almost like a clarion kind of call. But of course, they gorged on the 6-month bills yesterday rather than the 3-month bills because these rate cuts are back in the market. And we've got a little bit more paper today, $58 billion of threes.
But I think that's the important thing. If you're buying, where on this curve do you buy? We're talking to an asset manager moments ago who said maybe it's not duration because if long-term inflation is settling higher, maybe you just want to be playing in the front end.
Yeah, they'll all come on and they'll say belly of the curve, buy fives. And that's it from Bloomberg Brief. The surveillance team can tell you on the curve.